Have you ever wanted to learn more about the stock market? I am here today to explain what it is, how it works, and even how to get started. We are going to cover a lot of ground in this podcast. So if you don't want to miss anything, let's get started. To help you understand how the stock market works, we will first discuss some basic concepts. Before you can grasp the market, you need to understand what a stock is. Some companies may choose to make shares available to the public, and these shares are the stocks that represent an ownership in said company. So when you hear a company stating they are going public, it means they are making their stock shares available for investors. There are different kinds of stocks available for purchasing. They give investors different benefits. For example, some can pay dividends. Dividend is the distribution of a company's earnings to its shareholder. When you have stocks in a company, you are a shareholder. This can be paid out as cash or sometimes in the form of reinvestment in additional stocks. Now that you know what a stock is, we can get down to the market itself. We could write a whole book about it. However, we will keep it simple and easy to understand. Stock markets facilitate the sale and purchase of stocks between individual investors, institutional investors, and companies, whereas the stock exchange acts as an intermediary connecting buyers and sellers. For example, the New York Stock Exchange is the largest in the world. There are several other exchanges, and we can name a few. The Nasdaq, the Tokyo Stock Exchange, the Shanghai Stock Exchange, and the London Stock Exchange are some of the examples. When you use a stock exchange to purchase your shares, you are in the vast majority of the time buying shares from another investor that has decided to sell his shares of that company. You may wonder how the prices are determined on the stock market. Plain and simple, supply and demand. At any given time, there is a maximum price someone is willing to pay for a certain stock, and a minimum price someone else is willing to sell his shares of the stock. It works basically like an auction, where buyers are bidding for the stocks that other investors are willing to sell. Prices can move up quickly if there is a high demand for a certain stock, or drop rapidly if investors are quickly trying to sell a stock. In early 2020, the rapid spread of COVID-19 had an initial impact of turning the market to a sell-off for a few days. Now, in 2022, we can see another downturn as inflation pressure, supply chain issues, interest rates, and the war in Ukraine are some of the big reasons creating tension, fear, and uncertainty, rallying the market to a poor performance. Another key concept to grasp regarding the stock market is understanding the idea of market makers. Basically, market makers are intermediaries between buyers and sellers, buying or selling and holding shares, continually listing them in the market to help create liquidity. Because of the market makers, you rarely have to wait to sell or buy a stock at the market value. In order to buy or sell stocks, the transaction needs to be carried out with a broker, an entity licensed to trade stocks on the stock exchange. In the old days, it used to be a person, and nowadays it is more commonly an online stockbroker that processes the entire transaction electronically. When you buy a stock, you are telling the broker what stock you want to buy and how many shares. The broker will relay your order to the stock exchange and market makers will fill your order at the market price. In order to be a successful investor, it is important to understand the ins and outs of the stock market. How can you invest in stocks? First and foremost, you need to decide if you want to trade or invest in stocks. Both can make you money and both have their fair share of risk. So as usual, make sure to be due diligent and understand what are you investing your money into. Following us is a way to learn. We'll be providing more content on investing in the near future. The main difference between trading and investing is that traders will jump in and out of stocks, aiming for a short-term profit. It can be a minute, a day, or a week. The main goal is to be in and out as soon as profit hits. It also does not matter which direction the stock moves, and traders can profit on moves up or down. Investors, on the other hand, are looking for long-term growth. They want to buy and hold on that stock. Normally, they will invest in companies they already know the sector or a company that provides something they are familiar with. The best investments are the ones you are familiar with what you are investing into. The next step is finding a broker that suits your needs. Investing and trading have different brokerage requirements. Things like trade execution time and fees play a big difference here. In the future, we will be analyzing different brokers. To keep up to date with our content, subscribe and hit the notification bell. The last thing you have to do is make sure you have a good foundation before you start to splash your money in stocks. The market can be very unforgiving with the uninitiated. Key takeaways. Stocks represent an ownership within a company you are investing in. Stock markets facilitate the sale and purchase of stocks. The New York Stock Exchange is the largest in the world. In order to trade stocks, you need to have a broker. There are several catalysts that can influence the market up or down. Remember to be due diligent and do your own research before investing any money. If you like this content and want to see more, please hit the like button and subscribe to support this channel. If you have a question or would like to know more about a specific topic, leave us a suggestion. Stay tuned and follow us on our social media channels for more information about stocks, forex, crypto, NFTs, and the metaverse. Disclaimer: we are not licensed to provide financial advice. This video is for educational purposes only.